today's presentation, I'm going to focus on planning options for the transfer of a primary residence. And there are a number of reasons why people may transfer their property. Oftentimes, I get a call from clients saying, I want to give my house to my kids, make things easy when I pass away. I don't need to worry about it. And while transfers of property often seem very simple, the pros and cons of doing those transfers during lifetime, upon passing, in trust, without a trust, transfer on death deeds, all of those different types of transfers need to be examined to ensure that it's appropriate given each client's specific situation. So there's really no one size fits all transfer. And there's a number of reasons why transfers may occur. So today we're going to talk a little bit about the types or the reasons why people may transfer their real estate, the pros and cons of an outright transfer with a reservation of a life estate, without a reservation of a life estate, primary reasons for transferring a property for Medicaid asset protection purposes. We're going to talk about probate avoidance purposes in transferring property as well, and the tax ramifications that go with any of those options. I'm predominantly speaking about New York law, since we're in New York, though I am admitted in Florida as well. And I will touch on some of the FinCEN items with respect to when things are reportable, based on my current understanding of it, and when things may not be reportable, especially when you're assisting your clients or your loved ones in making any of these transfers. Okay. So what are some reasons that people transfer property? Well, one of the biggest reasons that I see individuals transferring property is for Medicaid eligibility purposes and to protect assets for Medicaid purposes. Medicaid, I'm going to touch on just broadly to start, is a government program, and it's a needs-based program. So it's different from Medicare, and that's a big misconception. People think that, Medicare covers care at home, care in a nursing home, and it doesn't long term. So a number of individuals in our community rely on Medicaid benefits to help supplement any expense associated with their care at home or in a nursing facility. And Medicaid has both resource requirements, financial requirements, and physical eligibility requirements. From a resource perspective, there are certain assets that are exempt for Medicaid purposes. A home that a Medicaid applicant lives in is exempt for Medicaid purposes up to a certain dollar amount. And for 2026, that amount is $1,130,000. So you can have a house in Scarsdale worth over $1 million, up to 1.13, and technically that's an exempt resource for Medicaid purposes. Medicaid isn't going to make you homeless and say you have to sell your house and use your $1 million of money first before you're eligible for Medicaid. But what they will do is they will place a lien on your house after you pass away if it's in your name alone. Or they can also place a lien on your home if you're no longer living in it as your primary residence. So for example, someone might be in a nursing home and they might be on Medicaid in a nursing home because they filed something called an intent to return home, where they told Medicaid, don't look at the value of my house because I plan to go back there. Get me my Medicaid benefits, and my house is still an exempt resource. But if that house is in the person's name alone when they pass away, Medicaid can seek that money back and get reimbursed from the value of for the value of what they paid out. So while it is an exempt resource, it's often an individual's most significant asset or a very significant asset as part of their estate. So what individuals seek to do is to protect their home for Medicaid purposes by transferring it into a Medicaid asset protection trust, which is an irrevocable trust, though it's a defective grantor trust for tax purposes, meaning that any income generated by the irrevocable trust is includable on the grantor's income tax return personally, and the value of the trust assets are still includable in the grantor's estate for tax purposes. And we'll talk about the benefits that that brings for most individuals. So Medicaid has certain resource eligibility limits. I include some exempt resources here as well, though we're going to focus today really on how the real estate in your home is subject to any sort of Medicaid claims. Now, Medicaid also has something called look-back periods. And you might have heard individuals talk about a 5-year clock, a 5-year look-back, a 5-year ineligibility period for Medicaid. And that has to do with the Deficit Reduction Act of 2005. So effective for any transfers after February 8th, 2006, so now over 20 years ago, that created a 60-month look-back period for nursing home Medicaid applicants. What that means is that if someone applies for nursing home Medicaid, the Department of Social Services here in Westchester wants to know what they did with all of their money over the past 60 months, 5 years. They want to see all transfers in and out of their bank accounts. They want to know if they moved any property out of their name for less than fair market value. Did they move properties into trusts? Did they make any gifts? And if they did make any gifts of assets during that 5-year period that are uncompensated transfers, meaning they did not receive anything of value back, that is considered a gift that disqualifies them for Medicaid. Medicaid deems basically any gift made during that 5-year period for purposes of qualifying for Medicaid, even if they didn't do it for purposes of qualifying for Medicaid. So let's say that you have a relatively healthy individual come to see you and they previously made some gifts to their kids for a wedding or for schooling or things of that nature. And then not shortly thereafter, they get sick and they need to go into a nursing home because they cannot stay at home. Medicaid would argue that those gifts that were made were in contemplation of Medicaid and were made to lower the value of their estate for Medicaid purposes and what resources were available. Now, there is a process, a fair hearing process to argue that, but that's really the standard that people are looking for. And oftentimes the transfers made are for purposes of qualifying for Medicaid, such as what we're going to talk about now. So when someone transfers their house to a Medicaid asset protection trust, it's generally a transfer made to protect that asset for Medicaid purposes after 5 years. Because since Medicaid only looks back 5 years, they don't care about what you've done with your money after 5 years. So if someone comes to me and puts their house in a Medicaid asset protection trust today, 5 years from today, that property would essentially be invisible for Medicaid purposes because they no longer own it. Now, in order for assets to be protected for Medicaid purposes, the prior owner cannot have certain incidents of ownership. So they can't have the right to go get that property back. But especially with someone's home, it's important that they can still do certain things with the house, like live in it. And that is allowed. Under a Medicaid asset protection trust, a creator of the trust can have the right to live in that house for the rest of their life. Their spouse can have the right to live in that house for the rest of their life. So that's really important because they want to be able to live in it. There's other tax benefits as well, which I'm going to talk about momentarily. One thing I do want to note is that while there is a 60-month look-back period for nursing home Medicaid, the other half of Medicaid, the Medicaid program, is something called community Medicaid or home care Medicaid. And that currently does not have a look-back period. So I could have $1 million of cash today, and I could gift it to my father tomorrow. And if I otherwise am in need of Medicaid benefits, I need help at home, I need help with activities of daily living, technically by the 1st of April, as long as my assets are below the resource limit, which is currently around $30,000, I could be eligible for Medicaid benefits. So community Medicaid does not have a look-back period for gifts. Now, back in 2020, in October of 2020, they did implement a 30-month look-back period for home care Medicaid. But as of today's date, that has not yet been implemented, and there is currently no look-back for home care Medicaid. First, it was delayed because of the public health crisis and COVID. Then the Department of Social Services and the health department could not determine how to necessarily implement this 30-month look-back period. We have spoken with them, the New York State Bar Association has, and we still have no indication of them starting this look-back period in any point in time soon. So as of now, there is no look-back period for community Medicaid. Okay, So like I said before, there's something called an uncompensated transfer, which is a gift, and that triggers a period of ineligibility for Medicaid purposes. And if someone goes into a nursing home and they made a gift within 5 years, there's a calculation as to how many months they are disqualified for Medicaid based on the value of the gift. So for example, if a gift is made and it's valued at $100,000, that disqualifies someone for Medicaid for 6.65 months. So you might be saying, okay, well, I have a $500,000 house. I'll hold on to it until I'm ready to go into a nursing home, and then I'll make the gift. But sometimes it's not that easy, because if your property is worth more or your assets are significant, that period of ineligibility only starts when you're in a nursing home. So it starts the first day you're in a nursing home. So it's important to make these gifts in advance and hopefully stay out of a nursing home for that 5-year look back period, and therefore protect your assets without having any sort of period of ineligibility in addition. So the look back period is the length of time that Medicaid looks back to see if assets were transferred. And the penalty period is the length of time that a Medicaid applicant is disqualified for Medicaid. Okay. We talked a little bit about Medicaid estate recovery. Assets that are in someone's name alone, Medicaid can recover. So it's often important for assets to be held in trust, irrevocable trust, joint bank account with beneficiaries listed if they are looking to be on Medicaid, because we don't want any assets going into someone's estate if they're a Medicaid recipient, as that would trigger Medicaid estate recovery. So the first reason people transfer assets out of their name is to become eligible for Medicaid. And your home is often a no-brainer asset that people choose to transfer because you're not pulling an income stream from it often. It has a significant value, and it would be something that Medicaid could place a lien on after you pass. The second reason that people transfer assets out of their name, and sometimes their primary resident or their home, is for tax planning or gift tax planning purposes. So here in New York, we do have a state-specific estate tax, and the New York estate tax exemption for 2026 is $7.35 million. The federal exemption is currently $15 million per person, and those exemptions have some differences. So the New York exemption is just an estate tax. It is not, or an estate tax exemption. It is not a gift tax exemption. New York does not have a gift tax, meaning that when you make gifts during your lifetime, New York doesn't care the value of the gifts that you make, as long as you do not make them within 3 years of the date of your death. If you make a gift within 3 years of the date of your death, it comes back into your estate for calculation purposes of the size of your estate. The other big difference between the New York estate tax exemption and the federal exemption is a concept of portability. So the New York estate tax exemption does not have portability between spouses. The concept of portability is where, let's say, I, God forbid, pass away and I leave all my assets to my husband, Brian, and he now has all of our money. Federally, he can also take my unused $15 million exemption and add it to his $15 million exemption, meaning that he could gift away then during his lifetime or at his passing $30 million of assets. In New York, we don't have portability. So if I, God forbid, pass away in New York and I leave everything to Brian, he essentially loses my New York estate tax exemption, just disappears. He can't port it over to him and then have $14 million plus of exemption. So it's really important to do unique and specific New York estate tax planning in order to afford the first spouse's, or the surviving spouse, the ability to utilize the first spouse who passes exemption by having either credit shelter trusts in estate planning documents, disclaimer trusts in estate planning documents, or the ability to disclaim assets by law. So it's very important that assets don't pass between spouses automatically when the couple has any sort of potential for a taxable estate. We also in New York have something called an estate tax cliff. So if you go over 7.35 million by 5% or more, then the value of your estate that is taxed is not just the difference between 7.35 and the overage. Every dollar back to $1 is taxed, and that's a significant and onerous tax. The top tax rate is 16%. So it's important to understand that if you go over the estate tax exemption by 5%, it's not just a tax on what's over the exemption amount, it's a tax on every dollar back to $1. Federally, there is portability between spouses, so that's a good thing. And the top tax rate for the federal estate and gift tax is 40%. So combined, if you have a federal taxable estate and a New York taxable estate, you're looking at over a 50% tax rate. So doing planning for that is very important, and often transferring property is part of the planning options available. Sometimes personal reasons are reasons for transferring property out of someone's name. Generational wealth transfers, charitable intent, generosity to children, and probate avoidance by transferring property. Okay, so let's talk about ways we transfer property out of our names. The first way is outright. Client calls you up, says, I'd like you to prepare a deed transferring my house to my son, Joe. Okay, well, what does that actually mean from a tax perspective? First, let's talk about capital gains. When property is transferred during lifetime, we don't get something called a step up in basis. And I'm going to explain this the way that my law school professor explained basis to me, which was with a pen, because it is stuck and it works. So let's say that I bought this pen for $2. Okay, I bought it for $2 and I'm giving it to you, and you now have this pen as a gift. Your basis in this pen is something called carryover basis. It's $2. You have a basis of $2. If you then sell this pen for $10, you incur a capital gain of $8 because you now have appreciation and you have to pay taxes on that like income. So from a capital gain tax perspective, transferring property outright without the reservation of a life estate, which we'll talk about momentarily, is not always desirable from a capital gain tax perspective, especially given the appreciation of real estate that we have seen in New York over the years. It is often that a client comes in to see me and they have a $800,000 to $2 million property somewhere in Westchester, and they bought it for around $80,000. So if they bought their property for $80,000 and they gift it to their son Joe outright during lifetime, he now has a basis of $80,000. And if he turns around and sells that property in the future, he has to pay a capital gain tax between $80,000 and what he sold it for. Now, certainly there's certain things that'll decrease the capital gain, personal residency exclusion of $250,000 per person or $500,000 for a married couple. Capital improvements, decrease your capital gain tax, but it's often not desirable to transfer property that way. From a gift tax perspective, an outright transfer of property could also trigger utilizing some of your gift tax exemption for federal estate and gift tax purposes. Gifts of $19,000 or less per person per year are exempt in the sense that you have an annual exclusion amount of $19,000 per person per year. You can gift anyone in the world that amount of money without having to file a gift tax return. If you gift someone more than that amount, then you have to file a gift tax return federally. That doesn't mean that a gift tax has to be paid, but it means that you're using some of that $15 million gift tax exemption available to you. The gift that's made is not the carryover basis amount, it's the fair market value of the property. So again, if mom transfers her property to Joe, he gets a basis of $80,000, but she has to file a gift tax return demonstrating that she's used $800,000 of her lifetime gift tax exemption federally. Now, whether or not that's a big deal really depends on the size of someone's estate. Sometimes it's a good thing to get money out of your name and use some of the exemption because future appreciation of that property then grows outside of the individual's estate. Same transfer of property. income taxes, or I'm sorry, real property taxes. If mom's living in that property and she's a senior, she might be getting a star exemption, an enhanced star exemption, veterans exemption, any sort of senior citizen discounts. And if that's transferred to a child outright without the reservation of a life estate, those tax exemptions may disappear. From a Medicaid eligibility perspective, the outright transfer of a property is not ideal either, because then the individual doesn't have any rights necessarily to live there. They don't have a right to live in the property. It's also exposed now to the child's creditors, divorce issues that may arise with them personally. And if they pass away, now mom's house might be owned by her grandkids and her daughter-in-law, and she might still be living there, which may not be ideal. So those are things to consider when you're transferring property outright without the reservation of a life estate. So we talked about all of this. Okay. Now, what about with the reservation of a life estate? First of all, what's a life estate? A life estate is where someone continues to hold and own something that they are transferring otherwise. So when someone reserves a life estate, they're essentially reserving typically the right to live in the property. The value of the property would still be includable in their estate for capital gain tax purposes, meaning a step up in basis to date of death value would still be possible. And they would still get their star exemption, veterans exemptions, any exemptions they're entitled to. It's also not considered a completed gift for tax purposes. So it's a little bit better than an outright transfer without a reservation of a life estate, because from a capital gain tax perspective and from a federal gift tax perspective, it's still includable in the person's estate. From a Medicaid eligibility perspective, it still creates and triggers that 5-year look back period and would be protected after 5 years. And a number of years ago, when the 5-year look back period started, transfers of property with a life estate were really the way it was done. Once Medicaid asset protection trusts sort of came about, people have stopped doing transfers of property with a reservation of a life estate because there's safer ways to accomplish the same goal. So we talked about capital gains consequences. So in the Internal Revenue Code 2036A, the transferee of a residence could still receive a full step up in basis if there is a reservation of a life estate to date of death value. And you can also see what the definition of a life estate is there as well. So what happens though if that property is sold during the lifetime of the individual who has retained the life estate? You still would have a capital gain tax as if they were still owning the property themselves. And one of the biggest downsides I see, especially from a Medicaid perspective, is that the life tenant, the person who retained the life estate, has to receive a portion of the proceeds of sale based on the value of their life estate. And this is calculated based on life expectancy and the value of the property. So for example, I could retain a life estate in my house, and let's say I'm on Medicaid, like I moved my house to my kids, I'm now on Medicaid, I'm in a nursing home, and they can't take care of the house anymore. They have to sell it. If I still have a life estate, when they sell that house, a portion of the proceeds of sale has to come back to me. And if the proceeds of sale put me over the resource limit, then I may no longer be eligible for Medicaid. I might have to use that money to pay for my care for a period of months, or I may need to do something called a crisis plan where we can save around 50% of the money. So with a Medicaid trust, we avoid that issue if the property is sold later on. So from a gift tax perspective, like I said, a transfer of a property with a life estate is an incomplete gift. So under Internal Revenue Code 2702, the value of the property is with the grantor, and it's an exception, which from a step up in basis perspective, from a Medicaid perspective, is a good thing. Okay. Let's talk about Medicaid eligibility. So when you do an outright transfer, either with a life estate or without, it still does create that 60-month look back period for nursing home Medicaid. The other thing that's important to note is that 60-month look back period is not only a disqualification period for the creator of the gift, but also for their spouse. And sometimes we see this a lot now where individuals are married but separate, where one person does Medicaid planning and they think that they're doing things great for themselves separate from their spouse. But anything that one spouse does disqualifies the other spouse for Medicaid purposes as well. So if I own a house in my name alone and I gift it to my kids, that disqualifies my husband for Medicaid for 5 years also. All right, additional options for an outright transfer. So what are some other reasons that people transfer property outright? Let's talk about a qualified personal residence trust. This is a QPERT, and this is a tax planning mechanism for estate taxes to decrease the size of someone's estate. Oftentimes, these types of trusts are used for like family vacation homes that the goal is to get them to pass from generation to generation. High value property that has a low basis, and we need to get it out of the individual's estate for estate tax purposes. What a QPERT basically allows is the transferor, the person who owns the property that's transferring it to the trust, gets to retain the right to live in that property for a term of years. And because they've retained this right for a term of years, it decreases the value of the gift that they're presently making to the trust. So it's a way to essentially decrease a gift for federal gift tax purposes using less of your lifetime gift tax exemption while still getting the full value of the property out of your name as long as you live for the term of years. So it needs to be done very specifically. It's an irrevocable trust. And after the term of years, the property vests with whoever the beneficiaries are, typically children. When they receive that property, they don't get a step up in basis. So essentially what you're doing is you're getting property out of your name at a discounted value for tax purposes. But what you're forfeiting is that step up in basis to date of death value, because the value of the property would no longer be includable in your estate and therefore would not get a step up. So that's why it's a very good planning technique for property that people do not intend to sell and therefore would never incur that capital gain. Completed gift trusts. Oftentimes, individuals may transfer vacation homes, properties into completed gift trusts for their descendants, their children, other loved ones. This removes the value of that property from someone's taxable estate, and but it does not give that same step up in basis either. It would have a carryover basis for the real estate. Again, a very good candidate where either it's a high basis asset, like a newly purchased vacation home, where we're not as concerned about getting a step up in basis because the basis is already relatively high. It's a good candidate where we need to get assets outside of someone's estate for either New York estate tax purposes or federal purposes. Spousal lifetime access trusts, or SLATs, is another vehicle for an outright transfer of property. Still get carryover basis, but a SLAT is essentially a way to provide for a spouse for lifetime while still getting the value of those assets out of your taxable estate. There are important planning techniques when creating SLATs. They have to abide with certain rules of reciprocal trusts so that the IRS is not going to argue that they are essentially mirror images of each other and therefore are void. But another way to get those assets out of someone's name. Okay, let's talk about Medicaid asset protection trusts a little bit more. So if we're talking about protecting assets for Medicaid purposes, the outright transfer of property to an individual, not really the most logical planning technique. The outright transfer with a life estate, also not the best option, because with a life estate, the person who is retaining the life estate, while they still have the right to live there, we still get a step up in basis. The problem is if the property needs to be sold, they get the value of that life estate. The other issue is, what if the child passes away or they become sick or incapacitated? Now, the parent who's living in the property may have property that's owned by another individual that was not intended, and their children's creditors can still, put a creditor claim or a lien on that property as well. A Medicaid trust avoids that because it's not in the parent's name, it's not in the child's name, it's in a trust until that parent passes away. And that trust gives the creator of the trust certain rights. They have the right to live in the property. They still get their STAR exemption, veterans exemption. They can get income from the trust if there's an income producing asset in the trust. They still get a step up in basis to date of death value. If the property is sold, the trustee of the trust can sell the property and the full proceeds of sale would go into the trust and still be protected for Medicaid purposes. There's no reason for any life estate or value to go back to the creator. When property is sold, a new property can then be purchased for the person to live in by the trust. So it's really a flexible planning technique. And the grantor, creator of a Medicaid trust, can still have certain rights. While they can't go in and get their property back directly, they do retain the right to change the trustees of their trust. So let's say their kids are the trustees and their kids have done something they don't like. They can remove their kids as trustees and replace them with someone else. They also can have the authority to remove and replace the beneficiaries and change the beneficiary structure of the trust. Irrevocable trusts in New York are also revocable on consent of the beneficiaries. So if they really hate the planning technique, there is a way to get that property back to them by a statutory revocation. So we talked about from a capital gain tax perspective, it's good. They reserve a life income interest, a life estate in accordance with 2036A, and therefore get a step up in basis in the property. The transfer is an incomplete gift for Medicaid, for estate inclusion purposes. So therefore the value of the property is includable in their estate. Because of that, there's no annual exclusion available for the gift because it's not a completed gift. So there's really no gift that's being made for tax purposes. All right. If there is income being generated by a Medicaid Asset Protection Trust, under IRC 675-4, the grantor will be considered the owner for those purposes. So let's say you have a house in a Medicaid trust and then it's sold and the proceeds of sale are now invested and those investments are generating income. That income can stay in the trust or be paid out to the grantor, depending on what the trust terms say. But regardless of what happens, the income tax would still be the responsibility of the grantor on their personal return. That's a good thing because the trust tax rate for income tax purposes reaches the highest level much more quickly than someone's personal tax rate does. So you'd want it to be includable on their personal return because it would create a lesser tax overall. All right, we talked about the 60-month look back, 5-year look back period. We talked about Medicaid home care and how it does not disqualify for Medicaid home care. The additional transfer I wanted to talk about was a transfer to a revocable trust. So a revocable trust is kind of like this cup. So is an irrevocable trust. But a revocable trust is an entity that someone can create, and they're the creators, and they can be the sole trustees of, or trustee of that trust. The purpose of a revocable trust is often to avoid probate, where you do not want to have an asset in your name alone and therefore require your last will and testament to be probated. Where instead you want a trust document to indicate where your home should go or your assets should go after you pass away, who is the successor trustee of that trust, what are the contingent beneficiaries, terms, who pays for expenses. All of that can be outlined in a document that can read very similarly to a last will and testament, but it does not have any court oversight. We do not have to probate it. We do not need letters testamentary because the property is not technically in someone's name alone when they pass away. It's in a trust that they created. A revocable trust is revocable. It can be changed, it can be revoked, it's amendable. So it's an excellent flexible planning technique, especially where there's a likelihood of changing beneficiaries in the future, having multiple beneficiaries, where probate avoidance is important because of estrangement or providing for children in different amounts. Revocable trusts can be key in sort of streamlining that process and not opening the door to a will contest. So I really do like them as a probate avoidance technique. Revocable living trusts do provide for a step up in basis because you're not transferring anything, you're not gifting anything. The revocable trust is associated with your social security number. You're still eligible for your STAR exemption, veterans exemption. Nothing really changes, except now the property can go to your named beneficiaries without any court oversight. This summer, I believe it was this summer, maybe it was last summer. I think it may have been last summer. My years are starting to blend. Transfer on death deeds were introduced in New York, which is considered an option in lieu of a revocable living trust, where you can name a beneficiary on your property to avoid probate. I don't love TOD deeds quite yet. I'm not sure how much the title company has had to record them. I'm not seeing them utilized too much in my practice. Because there are some concerns. You know, you cannot name a contingent beneficiary, to my knowledge, on a TOD deed. You can't name a trust as a beneficiary either. So if you have multiple beneficiaries, it doesn't really work great. It does work when you're maybe, a single individual, you have your property going to one individual, you don't have the means to create a trust. It may help in avoiding probate, but there are also some concerns from the creditor perspectives. It appears that the creditor time frame to file a claim and bring the assets back into someone's estate for creditor payment purposes is longer than if it was in an estate. And also that could be concerning for someone who otherwise believes they are now the owner of the property, but actually creditors of someone's estate can still claim those assets and bring them back in. So I'm not entirely sure if I'd like to utilize a TOD deed right now, but there are a lot of options for planning purposes that accomplish the same goal. From a FinCEN requirement perspective, trusts do come into play. I know we talked about this with Richard a little bit at the beginning, but my understanding is that if you are transferring your property into a Medicaid asset protection trust, you're the grantor, creator of the trust that the property is going into, because essentially your social security number is on, or you're on both sides of the transaction, person to the same person who's the creator of the trust, it's not a reportable transfer. But if you're transferring property to a trust that does not have any association with you, you're not the grantor, you're not the trustee, then it would be a reportable transfer. Same for revocable or irrevocable trusts. Similarly, if your property is now in a trust and you sell that property and then you purchase a new property in the name of that trust, the purchase of the new property in the name of the trust is a reportable transfer. If there is an LLC that is selling property or purchasing property, that is a reportable transfer. So it's very important to keep those things in mind when doing trust planning. But essentially, a no consideration transfer from an individual to a trust where that same individual is the grantor, which is what I would see most in my practice, is not a reportable transfer. So that's a good thing. Okay. Planning options for a primary resident, key takeaways. So I know I've been rambling on, but some key important things to remember from the presentation. An outright transfer of one's primary resident out of your name during your lifetime has some concerns with capital gain tax, gift tax, and Medicaid eligibility, along with creditor protection issues that may arise. If you are retaining and reserving a life estate, there can still be an issue there if the property is sold during your lifetime. It can result in high capital gain taxes in that situation, just as if you sold it yourself. And there is some concerns with who is actually owning the property at the end of the day. It may not be what you ultimately desired.
Before you go to the next thing, I just wanted to pop in and give the course code. The course code is GIFT. The course code is GIFT.
Okay. So for Medicaid purposes, the most logical transfer is to a Medicaid asset protection trust. It provides the most flexibility, protection, and ensures that the creator of the trust still has certain rights and abilities, has their thumb on the money, and things are done in accordance with their wishes. From a tax perspective, there's a number of ways to transfer property. Often utilization of a trust is key, and sometimes outright gifts are the right answer, even if it does create a carryover basis or utilization of a gift tax, part of your lifetime gift tax exemption. So that is all I have today. I am putting my contact information on the screen. I'm happy to answer any questions via email or by phone. I have offices in White Plains and in Somers, New York. And I want to again thank the title company for having me today.
Thank you so much. Do you have time for just a couple of Q&As?
Sure.
Okay, I will try to pare them down, and whatever we don't get to, I will try to email everyone back. So we did have a question about transfer on death deeds. If the owner submits an intent to return home and is approved for Medicaid, will a transfer on death deed protect the home from a Medicaid lien since it would be non-probate?
Yes, I believe it would. I have not tested that, but it should act the same as a like beneficiary designation on a retirement account, a life insurance policy, or a bank account, where because it was not an estate asset at the time of passing, it would not be an asset where Medicaid could seek recovery on.
Is the Medicaid Protection Trust limited to the primary residence, or can all secondary homes be placed in a trust?
Secondary homes can also be placed in a Medicaid trust, which is very important because secondary homes are considered cash for Medicaid purposes. So even if you own that secondary home, if it's not your primary residence, Medicaid does not deem it exempt, even though it's a house that you sometimes live in. You can only have one primary residence that's deemed exempt for Medicaid eligibility purposes. So oftentimes it's even more important to put those secondary homes into a Medicaid trust to protect the value.
Okay. If a client comes to you after they have already given away their real estate and retained a life estate, is there any technique to get that property into a Medicaid trust without restarting the 5-year look back?
I'm sorry, can you say that again? Someone has the property in a life estate deed?
They have already given away their real estate and retained a life estate. Is there any technique to get the property into a Medicaid trust without restarting the 5-year look back?
No, I mean, technically the child who now owns the property would have to gift it back to their parent and then put it in a Medicaid asset protection trust. There is a way where like that child could put it into a Medicaid asset protection trust and thereby start a new 5-year look back period for themselves, but they would also be making a gift then into that trust unless it's drafted in sort of a wonky way. There are situations that I've had where clients have had life estate deeds and they don't like how it's drafted. They don't like that it's going to one person. They want more contingency planning, and they've decided to essentially undo the planning and start afresh. A lot of that depends on someone's health, their age, the value of the property. So a case specific situation. But the transfer of the property from a life estate deed into the irrevocable trust, it really wouldn't be coming from the grantor. And it can also sometimes get confusing from a Medicaid perspective if they had to track where it came from over the 60-month period.
In an interest of not going over too much, I'll ask one last question, and then if you have any other questions, you can shoot me an email and we'll try to get it answered. When you were completing the EIN application for an intentionally defective irrevocable Medicaid trust, do you use the grantor's Social Security number or the Social Security number of the responsible party? Is the trustee of the trust the responsible party for this purpose?
Generally, the grantor's Social Security number is used as the responsible party for the EIN.
Great. Thank you so much for a great CLE. We appreciate having you.
Thank you for
Always
having
a
me.
pleasure. And thank you everyone for coming.